Today, we're going to take a look at a fascinating method called market DNA. We'll be doing a visual walkthrough of this system. Basically, we're breaking down a documented trade cycle for copper, phase by phase.
Our goal here is pretty simple. We're just going to present the facts exactly as they were documented. Everything you're about to see comes straight from the source material, and we'll walk through the events just as they were recorded at the time.
So here's our game plan for today. First, we're going to look at the blueprint, which is phase 1, the initial plan. Then, we'll see how that plan made first contact with the market in phase 2. And finally, we'll wrap things up with a quick summary and some really important disclaimers.
All right, let's dive right into phase 1, the plan. This is the starting point, the initial blueprint for the whole cycle. And it was all documented on February 17th, 2026.
So the entire cycle was set to kick off the moment the price hit its primary entry point. You can see it there on the chart. It's labeled M right at 5.6613. Now the plan also had a backup, a secondary optional entry level at 5.418. That's labeled PC, and it was there just in case the price decided to dip lower first. Now, these are the core risk parameters that really defined the whole plan. The plan was built around a 20-day time window, which is called the trapezoid time duration. It also calculated something called a risk domain of just under 21%. You can think of these numbers as the fundamental guardrails for managing the trade from start to finish.
So you might be wondering, how does this actually translate into a real position? Well, using a hypothetical capital of $100,000 and capping the maximum expected drawdown at 5%, the model worked out a total position size of 0.43. This was then designed to be split into two smaller trades, each at 0.21.
And this is where all those parameters we just saw come together. The source material is very specific about how this is calculated, and I'll read it directly. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size.
So based on that, the plan laid out two potential outcomes. In scenario 1, if only that first entry point got triggered, the projected profit was about $950. But in scenario 2, if the price dipped down and hit both entry points, the projected profit more than doubled to over $2,000.
Okay, so that was the plan on paper. Now let's see what actually happened in the market. We're moving on to phase 2, first contact, which picks up the story just a few days later on February 21st, 2026. And here's the chart from that day. You can see pretty clearly the prices made a move since the cycle started. So, what was the key event that the documentation pointed out?
Well, this was the big first contact moment. The documentation states, and I quote, "The price touched the delayed mirror trapezoid left boundary at $5.8712.
So, to put that in simple terms, the first trade was active. The price moved up, not down, which means that secondary entry point was never triggered. The cycle was now officially in motion.
And that brings us to our wrap-up, and of course some very important disclaimers about what this documentation is and what it isn't. It is absolutely essential to understand that this is not financial advice. The model specifically prohibits using leverage above 10, and you should never invest essential personal funds. This analysis is purely for public model documentation and verification purposes. And finally, any risk management has to follow the user's own instructions.
And that concludes our walkthrough of this copper cycle up to phase 2. If you'd like more information or to see other documented cycles, you can always visit the source website. Thanks so much for joining us.